Picture this. You just got that beautiful notification on your phone. You know the one?
Oh, yeah. The best feeling in the world.
Right. You sold a digital product online. Maybe it's a $97 ebook or like a new Notion template you design. It is an amazing feeling. Pure passive income.
Absolutely.
You build it once and then you just sell it 1,000 times. But then, and this is where reality hits tax season rolls around.
Yep. The dreaded tax season.
And suddenly that beautiful dream crashes into this incredibly complex, archaic tax system that, let's be honest, was explicitly designed for brick-and-mortar businesses.
Right. Or traditional W-2 employees. It definitely was not built for a digital creator selling PDFs on the internet.
No, not at all.
I mean, it is the ultimate gray zone. The rules feel super murky. The penalties for getting it wrong are incredibly harsh. And the traditional professionals who might actually be able to help you navigate it, they want to charge like $200 to $500 an hour just to look at your spreadsheets.
Yeah, which is crazy.
It is. The whole thing leaves most people completely paralyzed.
Which is exactly why we're doing this deep dive today. We want to cut through all that paralysis. Our mission here is to completely shortcut your path to being totally well-informed on this topic.
Because you really don't have to be paralyzed by this.
Exactly. We want to show you how you can actually leverage AI to automate, optimize, and completely protect your digital product taxes. So, you can actually keep more of your own money.
And we are pulling all of this from a single, highly authoritative source today. It's this battle-tested playbook called The Creator Tax Shield by Yeva Briner.
It's so good.
It really is. It's essentially the modern creator survival guide to the IRS.
Okay, let's unpack this. Because we have to start with the most urgent threat to your wallet. If you've been selling online for a while, you might be used to flying somewhat under the IRS radar.
Yeah, a lot of people are.
But there is a massive upcoming rule change that is going to make that physically impossible.
That's right. The era of, flying under the radar is officially over. And it all centers around this specific IRS form called the 1099-K.
Right, the 1099-K.
Historically, payment processors and platforms, so think Stripe, PayPal, Gumroad, Shopify, they only had to send you and the IRS a 1099-K if you crossed a pretty high threshold.
It was at $20,000, right?
Exactly. You had to have over $20,000 in gross payments and also more than 200 transactions.
Okay.
If you made less than that, the platform didn't report it automatically. The IRS, essentially, they had to rely on the honor system for you to report your own income.
But starting in 2026, the floor is just completely dropping out.
Oh, it's plummeting.
Yeah.
Starting in 2026, that reporting threshold drops from $20,000 all the way down to just $600.
Wait. Just to be crystal clear here, that is $600 over the course of a whole year.
In a calendar year, yes. So if you sell just one $97 ebook a handful of times, and you receive more than $600 total across any of these payment platforms, the IRS automatically knows about it.
Because they already have a copy of that form.
Right. They have the 1099-K. And if you do not report that income on your tax return, their computer systems are going to automatically flag you.
And here is the fatal mismatch where so many creators get caught. The source material spends a lot of time on this. Creators often mistakenly report their net income.
Which makes sense logically, but it's totally wrong for taxes.
Right, because the net is the money that actually hits your bank account, after the platform takes its processing fees or after you've issued refunds.
Yeah.
But that 1099-K form, that form reports your gross income, the total raw amount before a single cent of fees were taken out.
And that mismatch between your net and your gross, that is exactly what triggers the audit.
Right. So previously we've thought of this like a bouncer at a club tracking the total head count at the door. That's your gross. But you, as the promoter, are only telling the club owner about the net drink sales at the bar. But let's upgrade that metaphor to fit the IRS because it's so much more aggressive than that.
Oh,
The IRS isn't just a club owner checking receipts at the end of the night. Their system is like an automated camera pointing at the bouncer's clicker, and that camera is permanently wired to the cash register.
That's a terrifying mental image, but yeah.
If the clicker says 100 people walked in, but the register only shows 99 drink sales, the camera automatically prints a fine and mails it to you. Like no human is even looking at it, right?
That is the perfect way to describe it. What's fascinating here is the sheer mechanics of that automated camera.
How does it actually work?
Well, the IRS uses a computer scoring system called the DIF, which stands for Discriminate Inventory Function.
Okay.
It is entirely automated. If your reported gross income doesn't perfectly match the gross on that 1099K, the DIF system automatically spits out a CP2000 notice.
A CP2000.
Yeah, that is an automatic audit letter proposing changes to your tax bill. I mean, a human agent didn't even decide to audit you. The machine just saw a math discrepancy and fired off a penalty.
So how do we fix this? Like, how do we make the bouncers quicker and the cash register perfectly agree so this automated camera doesn't flash?
The fix is incredibly simple, but highly non-obvious if you aren't an accountant.
Right.
You absolutely must report your gross income on your Schedule C, line 1.
Okay, line 1.
Yes. You type in the exact number as it appears on your 1099K. Then you deduct the platform fees, the refunds, and the chargebacks as separate itemized expenses further down the form.
So you separate them out.
Exactly. You put your platform commissions and fees on line 10, and you put refunds or chargebacks on line 27A.
Oh, I see. So your actual net profit, like the money you are actually paying taxes on at the end of the day, it's the exact same either way.
Right.
But you've shown your math to the computer.
Precisely. Your gross matches their records, the DIF system stays perfectly happy, and this one simple adjustment prevents, like, 90% of the CP2000 audit notices that digital creators receive.
Okay, that is a huge relief. But the playbook points out that even when you report perfectly, there is this massive financial shock waiting for new creators. And that is the self-employment tax.
Ah, yes. The hidden 15.3%.
It's brutal.
It really is. See, when you're a W-2 employee, your employer pays half of your Medicare and Social Security taxes, and the other half is just quietly taken out of your paycheck before you ever see it.
You don't even notice it's gone.
Exactly.
Yeah.
But as a digital creator, the IRS considers you self-employed. So you pay the full 15.3% tax on your net profit. And that is in addition to your regular federal and state income tax.
Right. Just to put real numbers to that, if your net profit from your digital products is, say, $80,000, you owe over $12,000 in self-employment tax alone, before regular income tax even enters the chat.
Yep. It's a tough pill to swallow. And if you are a high earner, which the IRS defines as over $200,000 for a single filer or $250,000 if filing jointly, there is another 0.9% Medicare surtax stacked right on top of that.
Wow. But there is a silver lining, right? You can deduct half of your self-employment tax on your Form 1040.
Correct.
Which lowers your adjusted gross income, which in turn lowers your overall income tax.
You do get a slight break there. But to even get to that point safely, you have to survive that DIF computer system we just talked about.
Right, the automated camera.
And mismatched 1099Ks aren't the only trigger. The DIF system is constantly looking for other anomalies.
Like what?
It will flag you if your total deductions exceed 40% of your gross income, or if your home office deduction exceeds 20% of your income. It looks for 3 or more consecutive years of business losses, or unusually large software and subscription expenses relative to the size of your business.
Which brings us to a massive logistical problem. If high deductions and messy categories are what trigger these automated audits, how on earth does a solo creator accurately categorize thousands of scattered microtransactions?
It's a nightmare manually.
Right, we're talking software subscriptions, a few dollars in ad spend here, an internet bill there, a random course purchase. Doing that manually takes dozens of hours, or you're paying a bookkeeper $100 an hour to categorize a $9 charge.
Yeah, the math just doesn't work.
This is where the source material introduces the AI strategy, right?
The 10-minute AI workflow?
Yeah.
This is where the whole game changes for creators. Instead of manual sorting, you just export your raw transaction data as CSV files directly from Stripe, PayPal, your business bank accounts, and your credit cards.
Just download everything.
Right. You combine them into one simple master spreadsheet. You only really need 4 columns: date, merchant, amount, and account source.
Okay, simple enough.
Right.
And then you feed that raw data to an AI chatbot like ChatGPT, Claude, Gemini, whichever you prefer. But it's not just dropping it in and saying, hey, do my taxes. You have to use a very specific master prompt.
The prompt is the secret sauce here. You instruct the AI to act as a certified tax categorization expert. You tell it to assign exact Schedule C line numbers to every single transaction, to cite the specific IRS rules justifying it, and most importantly, to apply strict deduction percentages.
Like what kind of percentages?
For instance, the prompt dictates that software is 100% deductible, internet is 80%, phone is 70%, meals are 50%, and equipment under $2,500 is 100%.
Wow.
Yeah, and you ask it to output everything into a clean table that you can just copy and paste back into your sheet.
That saves so much time. But the real magic the playbook highlights is what it calls the orphan transaction detective.
I love this concept so much.
It's so smart.
After that first AI pass, the chatbot will inevitably flag a bunch of small transactions as unclear or personal. These are the orphans. And usually, human creators just ignore them because they are small. $10 here, $15 there.
Yeah, it's just not worth the mental energy to figure it out.
Exactly. But you don't ignore them. You run a follow-up prompt. You tell the AI to look closely at all the unassigned transactions under $50. You ask it, could a digital creator reasonably claim this as a business expense?
And the example in the book is amazing.
It really is. The AI spots a $9.99 Kindle purchase from Amazon. Now, on its own, it looks completely personal, just someone buying a book.
Right.
But the AI recategorizes it as competitive research or inspiration for your own ebook business.
Now, hold on. I have to push back here for a second.
Okay.
Are you telling me the IRS is going to accept a ChatGPT prompt as legal justification for me writing off my Amazon reading habit?
Right.
Because that sounds incredibly risky.
That is a great distinction to make, and it's vital to understand the legal boundaries here.
Mm-hmm.
The AI is not making it legal. The AI is simply recognizing patterns that fit the IRS definition of an ordinary and necessary business expense.
Ah, ordinary and necessary.
Right. If you are writing a sci-fi ebook, buying other sci-fi ebooks to analyze their formatting, looking at market trends, that is a completely valid, necessary expense for your trade.
That makes sense.
The AI just flags it for your review. It's up to you to honestly say, yes, that was for research, versus, no, I just wanted to read the new Stephen King novel on vacation.
So you still have to be honest.
Absolutely. But by surfacing those valid expenses, the playbook notes this single step usually recovers between $500 and $2,000 in missed deductions.
Wow.
Yeah. The AI spots patterns in those microtransactions that a human simply gets too fatigued to notice.
That makes total sense. And then there's the mixed use estimator, because things like your phone and internet aren't just for business. I mean, you watch Netflix on that same internet connection.
Exactly. And the IRS says you need a reasonable allocation.
So you prompt the AI with your actual usage habits, saying something like, I work from home, I use the phone for customer support, but I also use it for personal social media.
Right. And the AI will output a conservative, moderate, and aggressive estimate, usually landing around 70 to 80% for internet. And it will actually cite IRS Revenue Ruling 2011-14 to back it up.
That's incredible.
It's essentially building your audit defense case simultaneously while it does your bookkeeping.
Here's where it gets really interesting, though. What happens if my software expenses double in 1 year? Let's say I upgraded all my marketing tools. Won't that massive jump in deductions trigger that automated camera we talked about?
It absolutely might. The IRS expects consistency.
Right.
A huge jump in expenses without a corresponding huge jump in income is a massive red flag. But the AI workflow anticipates this.
Yeah.
There is a specific year-over-year comparison prompt.
Oh, nice.
You ask the AI to compare last year's categorized deductions to this year's, and specifically flag any category that jumped by more than 30%.
And then what does it actually do with that flag data?
The AI preemptively drafts a one-sentence business justification for that jump.
Just one sentence.
Yep, for example, it will write, launched a new high-ticket product line requiring premium subscriptions to Kajabi and ConvertKit.
Oh, I see.
Now, you do not send this to the IRS when you file. You just keep it in your files. If the IRS ever does ask about the jump, like 2 years from now, you aren't scrambling to remember why your software costs spiked.
You have a contemporaneous written business reason ready to go.
Which auditors love.
Okay, so we've tracked the transactions, we've found the hidden gold, we have our defenses ready, but now we have to actually hand over money to the government.
Unfortunately, yes.
And this introduces the nightmare of quarterly taxes.
Right. If you expect to owe more than $1,000 in taxes for the year, the IRS requires you to make estimated tax payments every quarter.
Every 3 months.
Yep. If you miss them or if you underpay, they hit you with penalties and interest. And the kicker is that applies even if you pay your entire tax bill in full on April 15th.
Wait, really? So you still get penalized for not paying it evenly throughout the year?
Exactly.
But a creator's income isn't steady. It's not a biweekly paycheck. I mean, you might launch a new course in February and make $15,000 in one weekend, and then make, like, $2,000 in March.
Exactly the problem. Traditional quarterly estimates just take your projected annual income and divide it by 4. It assumes you make the exact same amount every month,
Which is never true.
which is why creators absolutely have to use a different method. It's called the annualized income installment method.
Okay.
It is IRS Form 2210,
Yeah.
Schedule AI.
Okay, stop right there. How does that math actually work to protect a creator?
Instead of taking your year-end total and dividing by 4, the annualized method calculates your tax burden based only on the actual revenue you made in that specific 90-day window. It stops the IRS from assuming your $15,000 launch month happens 12 times a year. You only pay taxes on the money you actually banked in that specific quarter.
That is so much better.
And the playbook helps you build this using a really simple 3-tab Google Sheet setup.
Right, so tab 1 is your income, updated weekly from your Stripe exports. Tab 2 is your expenses, pulled straight from that AI audit trail we just made. And tab 3 is the quarterly calculator that runs the tax formulas based only on the past 90 days.
Exactly. But the real lifesaver the playbook dives into is the safe harbor rule.
Yes. Let's talk about safe harbors.
This is how you avoid underpayment penalties entirely, even if your estimates are a little off. Safe harbor number 1 says that if you pay 100% of whatever your total tax liability was last year, or 110% if your adjusted gross income was over $150,000, you will face 0 penalties,
No matter what.
no matter how much you actually end up owing this year.
This is huge. Let's look at the case study and book. There's a creator named Sarah. So in 2025, she made $45,000, and her total tax bill was $9,800. But in 2026, she is having a massive year. One of her videos went viral, and she projects she will make $120,000.
Right. And if she just estimated her taxes normally for 2026 based on that massive growth, she'd have to drain her cash flow to send the IRS about $28,000 over the 4 quarters.
Right. But instead, she uses safe harbor number 1. She only pays $10,780 evenly across the 4 quarters, which is exactly 110% of her last year's bill.
Yep.
She legally keeps the remaining $17,000 sitting in her own bank account, maybe earning interest or, funding her business growth all year long.
Exactly. Now, she still has to pay the rest of what she owes when she filed her final return in April.
Right. It's not free money.
No, but she avoided all penalties and kept her cash flow alive during a massive growth year. Applying this specific safe harbor math is like a legal cheat code for preserving cash flow.
It really is. You hold on to your money longer, and safe harbor number 2 is just paying 90% of this year's actual liability, which that AI Google Sheet tracks for you automatically anyway.
Exactly.
Okay, so we've been talking about exploiting AI and claiming aggressive safe harbors to build this, fortress around the IRS. But our digital products live on the internet, which means anyone in the world can buy them.
Oh boy. Yes.
The internet doesn't have borders. And this brings us to a terrifying hidden landmine: international taxes, specifically VAT and GST.
This is where a lot of creators bleed cash without even knowing they are liable. Under international tax treaties, digital products like your ebooks, templates, or courses, they are classified as electronically supplied services, or ESS.
ESS, okay.
And the general rule globally is the destination principle.
Wait, for those who haven't sold internationally, VAT is value-added tax and GST is goods and services tax, right? How is that different from what we do here in the U.S. with sales tax?
That's a really crucial distinction. In the U.S., sales tax is often based on origin or having a physical presence, like a nexus in a state.
Right.
But internationally, the destination principle means you owe tax in the country where the consumer lives, regardless of where your business is based.
Wow.
Yeah, so if someone in Paris buys your PDF, you owe the French government tax on that sale.
And every country has different thresholds for when you actually have to start collecting and paying that tax. Like the EU has a centralized system called OSS, and their threshold is 10,000 euros. The UK is 85,000 pounds. Australia is 75,000 Australian dollars.
And that sounds reasonable, right?
Yeah.
You only have to worry if you sell a high volume in those specific regions.
Exactly.
But the terrifying part is the countries with a $0 threshold.
Right. South Korea charges a 10% VAT. India charges an 18% GST. Israel, Turkey, all of these have a $0 threshold.
Meaning, legally, You are required to register and collect tax from the very first sale you make to someone living in their country.
Okay, if I'm listening to this right now, my heart just dropped into my stomach.
I know, it's a lot.
You're telling me that because one guy in Seoul bought my $50 Notion template, I am suddenly an international tax evader in South Korea. Am I honestly supposed to navigate the South Korean government registry over 50 bucks?
That is the panic every creator feels. First, you need to know exactly where you stand, so you don't make decisions based on fear.
Okay, how do we do that?
The playbook provides an AI lookup table prompt. You take 12 months of your global sales data broken down by country, you paste it into the AI, and it instantly cross-references your sales against the current thresholds of all 30-plus major countries.
Oh, that's smart.
It tells you exactly where you are over the line.
And if you are over the line, you have two choices for implementing a fix. You can do it yourself, using a custom JavaScript snippet on your Gumroad or Shopify page to calculate and display the local tax based on the buyer's IP address.
Which is incredibly technical.
Right. The easier route is what they call a merchant of record.
Yes. Services like Paddle or Lemon Squeezy, they charge a 5 to 10% fee per transaction, which sounds high, but legally, they become the seller of the product.
Oh, they take on the liability.
Exactly. They buy it from you and instantly resell it to the customer. Because they are the legal seller, they handle every single international tax calculation, collection, registration, and remittance globally. You just get your clean net payout.
But back to my $50 sale in South Korea. If I'm not using a merchant of record, the source lays out a very pragmatic set of risk tiers for the do-nothing option.
Yes, the pragmatic approach. It breaks down like this. If your sales in a specific country are under $500 a year, the risk of enforcement is incredibly low. You monitor it, but you don't panic register.
Okay, deep breath.
If your sales are between $500 and $5,000, you're moving into medium risk. This is where you should seriously consider switching to a merchant of record to handle it seamlessly.
And over 5,000.
Yeah. If you are selling over $5,000 in a single foreign country, you are high risk. You must comply either by registering directly or using that merchant of record, because the international penalties can be double the unpaid tax.
Ouch. And what if I'm looking at my AI lookup table and I realize I've been selling in the UK for 2 years? I'm way over their 85,000 pound threshold, and I never collected a dime of VAT.
The book actually provides an AI prompt for a tax amnesty letter.
A tax amnesty letter?
Yeah. It generates a formal voluntary disclosure letter tailored to that specific country's tax agency. You explain that you lacked awareness of their digital goods laws, you provide the exact math of what you owe them, and you request a penalty waiver based on your good faith effort to step forward and come clean.
And does that actually work?
The author notes that using these AI-generated letters has successfully resulted in waived penalties in places like Germany and the UK. Governments prefer compliance over punishment when you approach them first.
It's amazing how much of this just comes down to communicating properly with these agencies.
Right.
Which brings us to a critical pivot. We've been talking about exploiting AI, claiming aggressive safe harbors, and optimizing every deduction. But let's be real, the more optimized your taxes are, the more exposed you feel.
Sure.
If this entire AI CPA replacement script actually triggers the DIF system we talked about, what is our safety net?
Your safety net is building your audit defense packet before you ever receive a letter.
Yes. You don't wait for disaster.
Never wait.
You create a secure Google Drive folder for the year.
Right.
Inside, you have highly specific subfolders. Income proof, business deductions with all those AI-generated receipts, home office documentation complete with square footage measurements and photos of your desk and your vehicle log.
The psychology of this is absolutely critical. The author emphasizes that if you get a notice from the IRS and you're able to respond within 24 hours with perfectly organized, beautifully documented, digitally pristine folders, it psychologically signals absolute legitimacy to the auditor.
Because they're just people, too.
Right. Auditors are just bureaucrats. They are overworked and they want to close cases. If you make their job incredibly easy and show you keep meticulous records, they are far more likely to accept your explanations and move on to an easier target.
And if you're already in a tax disaster, say you're paralyzed, you forgot to file for 2 years, you owe back taxes, and you're getting threatening letters.
The most important advice is, do not panic.
Hard to do, but yeah.
The IRS is not a monster hiding under your bed. It is a giant bureaucracy that operates purely on paperwork and deadlines. The playbook highlights that for tax balances under $50,000, installment agreements are very easily available online with minimal documentation. You just have to ask.
And this is where using AI as what the book calls the CPA replacement script is so revolutionary. Instead of paying a generalist CPA $1,500 to $5,000 a year just to do 3 hours of basic data entry into their own software, the AI acts as an always-on 247 strategist.
Exactly.
It sorts the data, applies the codes, and even drafts the response letters to the IRS citing specific tax codes.
And what's fascinating here is if we connect this to the bigger picture, this is not about firing all accountants and lawyers. That's a big misconception.
Right, we still need experts.
Exactly. It is about using AI to automate the 90% of manual reactive work, the sorting, the categorizing, the initial drafting.
Dizzy work.
Yes. You use the AI to do all that heavy lifting so that if you ever do need to hire a human professional, you are paying them for high-level, specialized strategic advice for your specific life situation, not paying them to do basic data entry.
It fundamentally changes your relationship with your own business finances. You move from being a victim of the system to being the architect of your wealth.
Beautifully said.
So what does this all mean for you, the listener? Let's wrap this up. We have covered a massive amount of ground today.
We really have.
You now have a complete toolkit to take control of your digital product taxes. You know about the 2026 1099K trap and the simple gross versus net fix on Schedule C to keep the automated cameras happy. You have the 10-minute AI audit trail workflow to find hidden deductions like the orphan detective for your Kindle books.
You know exactly how the annualized income installment method works and how to exploit safe harbors to protect your cash flow during a big launch year.
You know the reality of international VAT and GST, why the destination principle matters, and how to use an AI lookup table or a merchant of record to sleep soundly.
Yep.
And finally, you know how to build the ultimate audit defense packet so you can respond to any IRS notice in 24 hours flat.
It is an incredibly powerful system, but it does raise an important, somewhat provocative question.
Okay, let's hear it.
Something for you to mull over as you start implementing this in your own business. If everyday creators are now using AI to perfectly optimize their deductions, instantly exploit safe harbors, and generate flawless, legally cited audit defense letters, how long until the IRS and international tax bodies deploy their own AI to read and audit these AI-generated returns?
Oh, wow. I hadn't even thought of that.
Right. Are we heading toward a near future where our taxes are just two autonomous AI systems, your digital CPA and the government's digital auditor, quietly negotiating with each other in the background while we sleep?
Now that is a wild, slightly dystopian thought to end on. A machine-to-machine tax negotiation.
It's coming.
Until that day comes, though, you have the practical tools to protect yourself and your business right now. Thank you so much for joining us on this deep dive. Keep building, keep creating, and we will catch you next time.
Hey everyone, and welcome to today's Explainer. Look, if you sell ebooks, courses, software, or coaching online, you already know the harsh truth. The tax code was absolutely not written for you. It was built for traditional W-2 employees and old-school brick-and-mortar stores. But today, we're going to change that. We are breaking down a battle-tested tax system designed specifically for digital creators, drawing straight from the blueprint laid out in the Creator Tax Shield. We're going to look at exactly how you can automate your digital product taxes, massively slash your tax bill, and basically never fear the IRS again.
Okay, let's kick things off with a number that honestly should be setting off alarm bells for every single creator out there. $600. Starting in 2026, the new 1099K reporting threshold plummets from $20,000 all the way down to just $600. Yikes, right? This means if you sell a single course or even just a handful of ebooks and your total gross payments through platforms like Stripe, Gumroad, or PayPal cross that $600 mark for the whole year, the IRS automatically gets a copy of that data. Your invisible creator income? Yeah, it's no longer invisible. And if your reported gross income doesn't perfectly match their records, their computer will just automatically flag your return.
Now, I know exactly what you're probably thinking. You're sitting there asking, is this actually going to reduce my tax bill, or is this just another generic, boring track your receipts guide? Totally valid question. And the answer lies in this system's AI audit trail prompt. Guys, this isn't just tax theory. By pasting a single prompt and running your actual CSV data through it, this system identified an average of $4,100 in overlooked deductions for the creators who tested it. We are talking about real, tangible money staying right in your pocket.
So here's our roadmap for today. First, we'll cover the creator tax nightmare. Second, automating deductions without code. Third, solving international sales taxes. Fourth, mastering quarterly estimated taxes. And fifth, surviving audits and firing your CPA.
All right, let's dive into part one,
the creator tax nightmare, and how to set up safely.
So, one of the absolute biggest fears for digital entrepreneurs is that we usually lack the pristine, decades-long tax history of a traditional business, right? Which makes the threat of an IRS audit feel like a dark cloud hanging over us. But here's why you can actually trust this system. It replaces all that guesswork with a verified blueprint. This isn't just some random blog post from a self-proclaimed internet guru. It's been battle-tested on 230 creators, verifying that exact average savings of $4,100 we just talked about. Plus, it's endorsed by a whole board leveraging principles from M1 Ukaicho for gamification, Robert Cialdini for psychology, and the scaling and discipline tactics of Rockefeller, Buffett, and Bezos. You're getting actual copy and paste prompts here, not just vague tips.
And hey, if you're a brand new creator, don't sweat it. This system works for you literally from day one. It teaches you how to structure your business safely right out of the gate. Only have 3 months of data? No problem. This system's quarterly estimator uses linear regression to project your numbers incredibly accurately. And if you're worried about getting audited without a long business history, it even includes a specific new business section that helps you prove your business intent to the IRS.
Moving right along to Part 2, automating deductions without code.
We all know the absolute nightmare of dealing with messy, unsorted CSV exports, right? Well, the AI audit trail completely wipes out manual sorting. Let's say you have multiple income streams: Gumroad, Etsy, maybe some freelance design work on the side. This prompt accepts all those different CSVs and automatically merges them into a single, unified expense log. It scans thousands of transactions and assigns IRS-approved deduction percentages on the fly. For instance, it just automatically knows to deduct your software subscriptions at 100%, your home internet bill at 80%, and those business meals at 50%.
And if you're not a technical person, take a deep breath. There is absolutely zero coding required here. No complicated APIs to hook up. You literally just export your CSV, copy and paste the master prompt directly into DeepSeek, Claude, or GPT-4, and paste your data. In about 60 seconds, the AI hands you back a perfectly clean IRS categorized expense log. I mean, it is literally that simple.
But what about when you get hit with a huge, sudden expense? Say you drop a bunch of cash on a brand new, high-end laptop. Do you deduct it all at once, or do you depreciate it? Well, the system automatically flags any transaction over $2,500. Then, it uses an AI depreciation calculator to show you the exact tax savings for both Section 179, which is deducting it all at once, versus spreading that deduction over 5 years. So you can just confidently choose whatever strategy works best for your current cash flow.
Okay, Section 3, solving international sales taxes. Oh boy, the VAT headache. Selling to customers in Europe or Australia feels amazing, until you suddenly realize you might owe a ton of VAT and GST. But instead of shelling out $5,000 for a fancy international tax consultant, this source material completely demystifies global compliance with a 30-country lookup table. Just look at this. It clearly outlines specific tax rates, the exact revenue thresholds you need to hit before you even have to register, and whether business-to-business sales are exempt. It completely removes all the scary guesswork from international sales.
But this is where it gets super cool, how we actually operationalize this. The system gives you step-by-step screenshots showing exactly how to embed this table straight into your checkout using Zapier and Google Sheets. So every single time an international sale comes in, boom, it automatically collects the correct local tax. And when you actually have to remit those taxes, the AI generates the filing forms for each specific country for you. No foreign accountant needed. It even writes penalty waiver amnesty letters just in case you need to retroactively register and want to avoid massive fines.
All right, Part 4, mastering quarterly estimated taxes.
Because creator income is notoriously up and down, it naturally leads to the question that keeps so many of us awake at night. How do I know I'm not drastically underpaying and triggering huge penalties, or overpaying and unnecessarily tying up all my cash?
Well, the solution here is the Google Sheets Quarterly Estimator. And again, absolutely no scripts for you to write. This template is packed with embedded AI formulas that sum up your gross income across every single stream you have into one clear liability figure. It projects your year-end sales with an insane 92% accuracy, and it literally sends you a monthly email alert telling you exactly how much to pay the IRS, down to the actual dollar.
Now, the real secret sauce here is how the AI leverages the IRS safe harbor rule. By automatically calculating whether it's cheaper for you to pay 100% of last year's tax or 90% of this year's liability, the system absolutely minimizes your required quarterly payments. In real-world testing, this specific tool saved clients an average of $840 in IRS penalties alone,
while preventing massive cash flow killing overpayments of $2,000 or more.
Finally, Section 5, Surviving Audits and Firing CPAs, the ultimate boss fight.
If relying on an overpriced generalist CPA doesn't make you feel totally safe, you are going to love this. The book provides a dedicated audit defense packet prompt. It scans your past returns, flags the top 10 IRS red flags, like, say, claiming a home office deduction that's more than 20% of your income, or having unusually massive meal expenses, and it automatically generates this beautifully pre-organized compliance folder. We're talking over 20 documents, perfectly structuring your receipts, logs, and worksheets exactly the way a grumpy IRS auditor wants to see them.
14. That is the number of clients who have already faced down an intimidating IRS audit using this system's one-page audit defense letter and passed with absolutely zero adjustments. None. It proves your deductions are completely legitimate by citing the exact tax code sections, essentially shutting down auditor questions before they can even snowball. That is huge.
Which brings us to the CPAs. So many creators are handing over $2,000 a year to a generalist CPA basically just to plug numbers into software. The CPA replacement script changes the game. It's a long-form system prompt that essentially turns AI into